Cool. Thanks, Dave. All right, my friends, we're going to jump right in. Before we do all of that, talk about why you're here today, more about the webinar and things like that. This is really um, my way of giving back. And I want to start off by saying and setting a very clear message of who I am and who I'm not. I am not your commercial real estate guru. I am not the probably even the most experienced person in this room. As you can see, John's got a little bit more gray hair than me. I'm sure he's seen something around the block that I haven't seen. But what I do have is some experience, right? So I do currently own several $1 million of real estate. And more importantly, I've spent years helping other investors find opportunities and helping them avoid mistakes. So the biggest lesson I've learned so far is the community you're building in real estate is going to matter more than any spreadsheet you're ever going to run, right? So anyone can run analysis. You can literally Google what I'm sharing with you today. You can even have software that you purchase. And if you're like me, ChatGPT now tells me I am a top 1% user over its platform. So you can use AI for everything that I'm telling you today. But deals don't fail because someone's mistyping something in a formula. I'm actually finding deals fail because of what's not seen. It's the behind the scenes, it's what's on site at a property, or even the people that are involved in a transaction. And that's why I wanted to bring some core people in my life together to talk with you today. Before we ever jump into your first deal or your next deal, here's the question I want you to be asking yourself. Who's representing the opportunity? Going beyond what's the cap rate or what's the projected return. What I want you to think is, who am I working with and are they reputable? What's their track record? Who are they in business with? And what kind of investor community is surrounding them? So, from the way I see it, a strong community is going to be a very good green flag for you, right? There's a lot of people in the greater Grand Rapids area that I've done business with that have started at one position and grown to another, and they're building communities as well. I think an emerging community like the one I'm trying to build here is also a green flag because it's going beyond ourselves. It's applying knowledge and giving the experience and paying it forward. So before I ever bought or owned any real estate, I came from a relationship banking background. I worked in the credit union world. That's how actually Brock and I met several years ago, is working for a local credit union. And from us, I went into upper management, at least that's the way I call it. I help business owners finance equipment, finance building, truly finance their dreams. And that gave me something most people don't ever get. And I got it early on in my career, a behind the scenes view of what actually keeps businesses alive and what is actually quietly killing them. So that killing, right, is the over leveraging. It doesn't look dangerous at first. It can even be positioned as confidence. It looks like growth in many ways until that pressure shows up. And pressure is going to look very different for many different people across their portfolio. It's going to look different in market segments. It's going to look different in the area that you're buying real estate. So my goal is pretty simple. I don't want you spending months chasing a deal only to realize the structure, financing, or even the representation was wrong from the start. So that's why I believe deal analysis even begins before the number. It's going to start with people, then it brings structure, and what are you doing to build your community? So that being said, that's my intro. That's me. That's behind the scenes. I told you that we were going to do some real deal analysis today. And before I jump into real deal analysis, what I want to say is what type of deals have we evaluated before? Because we are building that community. And I know when I'm working with someone, they might be pursuing a different type of product or service or house than others. So I have to be able to cater my language and how I'm representing you in different ways. So in the last 12 months, what kind of deals have we done? We've done short-term rentals. We've done 1 to 4 unit multifamily deals. We've done industrial new construction. We're working on several car wash evaluations. We've done single family home rentals, commercial multi-tenant. We've helped people do house hacking where you live in a unit and rent out the others. We've done multifamily new construction. I'm currently looking to go under contract with land to build a 40 to 48 unit apartment complex myself. That's something we're personally evaluating this year. And we've also worked with others on business leases, build to suit leases. So When working with us, what does a real estate deal analysis look like? What would you expect from me representing you, or what would I expect that you should have from an agent? So I finally had to, for this, put this into a framework of what I could show you. My framework consists of three real principles. I'm not doing this from an evaluation of just being a spreadsheet jockey per se. So what I really want to do is evaluate, how can I be a good steward of your capital, manage reputations and relationships? And what I look at is three things: numbers, the people, and long-term risk. And I've built this into like a checklist for my team and myself. And then you would see this presented to you in a memo when we analyze a deal. So 5 points if you're taking notes from today's webinar and how you can apply something when working with an agent or in your next purchase. This is probably the best spot to start taking notes. And then we'll work into getting question and answer panelists from there. So number one, if you're taking notes, the first thing I'm looking at is that human element, the human layer, before we even jump into the numbers. My starting point is always with you, right? So what is your motivation? What real estate are you looking to purchase? Because if I can leave you with a very important aspect of real estate is you're going to see all of the online reels, the social media saying, buy real estate, it's passive, you can build your future, right? That's true, but it's really not. And I say that because real estate is not a passive investment. I don't care what anyone is telling you, you're not going to see success in real estate by letting someone else control your train. Because what I know about real estate is it can give you the freedom, but it's not a very liquid asset. So what I need to do is, one, test your motivation, make sure I'm finding the right alignment. When I'm testing that, I'm going to match your motivation to see what the seller's motivation for a sale is, right? Why is a seller wanting to move away from a business or an asset? What is their pain? What is their opportunity? And how does that create possibility for you? I'm then also, as a business owner myself, matching your buyer profile, your investor profile in psychology with how does this going to operate for you? We then move that human element into an operator competency, right? I know that everyone I'm working with does not have the same level of experience. I might be working with someone that has a portfolio of several million. Well, I'm also working with someone that's working on their first multifamily deal. They've never purchased anything before. So when I'm thinking about an operator, the human element of this, one, there's the operator side of you, and then there's the operator side of how are you going into business? And for you, taking notes, think about your partners, think about your contractors, think about your loan provider, think about property management, right? Service providers and leverage. I want to make sure that we're talking about that before we even head into doing business together, because if I can't articulate that, or if an agent can't articulate the humans involved into this decision, you're already setting yourself up for failure. This is a huge important step one. In my memos, I also provide market behavior because where the market's going, where it's not going, what are we anticipating? I always want to say before we make our next purchase, I don't care if you've purchased 10 times with me. I'm still letting you know what the market behavior is, right? Days on market, inventory, rates, those things. What are we anticipating? Because I'm going to go back to this again. You could go to a financial advisor instead of me. You could put your money into the stock market, bonds, other, assets that you can invest in. What's different about real estate is, yeah, there's a lot of tax benefits. There's other people that, can play this and get their income lower. But if you have to liquidate real estate, you cannot liquidate it the same way that you liquidate a financial account. Real estate is very sticky. It's a slow process sale. And I need to make sure that you're aware of that if you try to sell it, because you can't turn around your portfolio and get money back within 24 hours to a week. It's going to take you a little bit of time. And then lastly, the human element, both for the buyer, seller, and myself. What reputation risk is there in this purchase or sale if this goes sideways? So my unspoken rule in most ways, and the way I'm operating myself is, if it doesn't make sense with the people, it's most likely not going to make sense with the math, right? Because if I can't put these things together and it's getting really hard, yeah, there's the diamonds in the rough. There's the things that people have ignored or walked away with days on market. But if I'm getting a huge amount of pushback or non-transparency from a seller, that's usually a good idea for me to say, let's walk away from this one. So the human element. Next, point two, cash flow, right? Does this thing even pencil, right? And how are we evaluating cash flow? So when working with our team in this memo, I'm going to break down what is the current reality of this business, of this multifamily, of this commercial deal. And then I have benchmarks because I've been a commercial lender for several years before doing real estate full time. And I've seen businesses operate, and I know that what the lenders are looking for. I mean, I've talked with John and Brock on many occasions of, hey, what type of mortgage brokers are out there and what are they looking for, and how can we get creative on this? So in our memo, I'm going to break down for your analysis debt service cover ratio. One, what does that mean for you? And we're going to get into that. I'm going to explain some of these terms to you today. I know some investors on this is going to be too elementary, but it makes sense for us to recap on it and then have the lenders talk about it too. So in our analysis, how are we performing today from the seller's perspective? And then what does that stabilized truth look like moving forward? Because we know things change in Michigan upon a sale. Taxes, insurance, those things are all going to be changing. So I have a couple key criteria that I'm evaluating on every single one of my purchase. This is happening on the back end. These are the things that you're not seeing that agents are doing that they should be doing for you in the value of the commission that they should be providing, right? Debt service cover ratio, DSCR. I know when I'm running my memos, I'm setting a floor. This is a minimum. This is not what you should aim for, but it's a floor of what a lender wants. 1.25 times, meaning the income coming in versus the expenses going out. They want to know that you're covering that at a 1.25 ratio at a floor. Yeah, we can get away from that from certain deals, but I don't advise it. And a 1-to-1 ratio means the income coming in is the same amount as the income going out. On a rainy day, you do not want that dropping below 1, right? Because now you know that you're tapping into your personal reserves to fund this deal, and that's not where you want to be. We then also collect all of the financial data before, and when we're doing due diligence, we get these profit and loss statements, we get tax returns. I'm spending hours evaluating these income documents for you to make a well-informed decision. What I know about the type of real estate that we're servicing is an expense ratio of 25 to 35% is very much expected. If I'm seeing something on a profit and loss that's deviated from that, call it 40, 50%, I'm quite often saying, hey, that's a value approach. What type of purchase price is here? Because if they're operating at a 40 to 50% expense ratio, that's probably a diamond in the rough. We can beat them up on purchase price, and then I know we can work in with like Zach, John, and other providers to then reduce that expense margin to find you income, right? High expenses, not necessarily a bad thing. That's an opportunity. Low expenses on a profit and loss, they're probably hiding something from us, right? So I know that's a trigger for me to do better investigation. So highly important to a lot of my clients is cash on cash return. Personally, that's not as important to me because I can find different financing structures, but quite often my investors want to see between a 7 and 10% cash on cash return. What's becoming extremely important, and this is one of the things that I want to talk about as my real estate predictions for this year, is cap rates are coming back. Cap rates are important again. So if you don't know what a cap rate is, I want us to spend time on that, but I'm just going to do a benchmark on it here today. Our market, Grand Rapids, is performing very close to an appraised cap rate. Our appraisers are looking at 7%. We do not want lower cap rates. That does not mean good things for our investors. I personally like to enter in and see if it's performing at a market rate cap rate. So I then want to see if taking on new ownership, can I get this thing to improve its cap rate by 1 to 2%? That higher that cap rate, I've just forced your evaluation up. And that's what I want to be able to do as your real estate advisor. And then from our area, I'm also advising in these cash flow formulas a rental growth, right? We have the as is reality for whatever rents they're getting, and then the stabilized future position of what this looking like for rental growth. I then need to factor in vacancy for your type of operations as well. Our area on multifamily and residential vacancies, we're operating at close to a 5 to 8% stabilized rental vacancy. Is it the same for Multi-tenant commercial? No, it's vastly different. And we need to compensate for that too, for how long leases are. Because leases on commercial, we're seeking 3, 5, or 10 years plus. And then we have to factor that into the evaluation. So, first 2 points were again that human element, and then we're talking about the cash flow. The third is the capital stack, meaning how are we putting together your financing deal? So, this is where I deviate from other investors. I deviate from other real estate agents. I'm not saying, can we buy this? I'm actually structuring my conversations with my clients around what structure is protecting my clients from a downside. So it is highly prevalent. It's coming back more and more of creative seller financing, and that is especially prominent around the broker deals that I'm doing with other lenders is, hey, can I add a seller second here to incorporate part of the financing? I've had a lot of conversations recently around like the 60% bank financing, 20% seller financing, and the rest coming from my buyer, right? Do I need to come up with the full down payment, or can I create some structure here that meets my lender's requirements? I'm quite often seeing the capital structure, the capital stack on this somewhere between a 65-35 loan to value, 70-30. Potentially we can go out to an 80-20 on these type of deals. If you're doing house hacking or owner financing where you're moving into it, we have other options, but quite often that's what we're looking at. You're somewhere between a 20 and 30% down payment minimum to participate in these deals. But what I am going to be asking John and Brock later is, how do we pull in capital investors? Can I do this deal with family and friends? Can I do co-signers, right? This is part of that capital stack too. How are we pulling the money into the deal? And that goes into my memo to break it down for you. So what my rule is, I need to make sure that the leverage, the lending that we're doing creates you margin, not remove it. So if I can add on a seller's second financing at a 0% interest rate with a future balloon payment, because that frees up $500 of your monthly cash flow, and now I'm performing closer to a $1,500 monthly cash flow for you, heck yeah, because I want to make sure you're cash flowing. And if there's creative ways to make a deal work, let's do it. Let's just make sure we're protecting you for the long term. The next thing I'm putting my clients through is a stress test. And I've coined some words that I use for my clients and with my team. I call this the positively thinking in the negative. So every deal has to pass those 3 criteria, and then I try to put it through a stress test. What happens in the next 24 months if rents stabilize or decrease? What happens if my rate has to go up 100 or 150 basis points? Can I refinance this in a bad year? And like I said earlier, real estate is extremely non-liquid. You can't sell it quick. But what if I had to sell this quick, right? Would I be able to sell my $500,000 asset for 350 in a year? Most often in our area, yes. But what does that look like? Turn times, days on market. I want to make sure that you have an exit strategy and a long-term strategy heading into doing business, because unlike buying a residential house, yeah, you can figure things out. That's your asset. You're living there. You can move things around or go into forbearance. With a business asset, it's much easier to walk away from that, file bankruptcy or something else. I don't want you to do that. I want to make sure that I've advised you as a real estate advisor and maybe a business coach to be protected for the future. The final element is that strategic fit. So going beyond profitability, does this make sense for your long-term portfolio? Do you have the right people servicing this beyond the real estate transaction? Am I doing a good warm handoff to strong people? And then making sure that, one, I've provided you enough education, you feel financially sound, and I've done a good stewardship of your capital. We're building community-based investing because I really do want to give back to this community. I think this is a fantastic community to invest in, and I think we are the right market to invest in. And then ultimately, always doing fewer bad deals, right? I've literally written on my board, no more bad partners. Like, it's one of my memos to remind myself of. And you wouldn't be here today if I didn't think that you were someone that would value from the same structure. So I got about 5 more minutes, John, and then we'll jump into your questions and questions and answers for everyone here. So taking those 5 elements, what does that look like? What would you get from me and again, I'm going to share this with you guys too. I'm happy to share you my framework in case it would add any additional value to you guys too. I send out an email deal memo, and it follows this strategy or this structure. First is going to be the property and market summary, going over the asset type, the location, why this market works long term, and how is it serving. Next, inside of the same structure of a memo that you get from me, is a current performance, right? Gross rents, other income, expenses, net operating income, and what does that debt service cover ratio look at based on its today performance? I'm then going to restructure that based on what I know a property should be doing, based on other deals I've helped buy and sell, and say, what would be optimized performance look like? So the best case scenario. So we go take everything up to its operational improvements, its rent alignment with the market, expense normalization, both minus or plus, and then what does that stabilized net operating income look like based around your lending scenario? Because that's what's mattering. We're building out that cash flow for you. Then we're looking at stabilizing that financing scenario. I'm going to give you the two approaches on. So there's one, the business optimization, but then we need to look at the financing strategies. So we have lots of connections. One, we're going to take a conservative approach to financing to make sure that, hey, in our worst case scenario, if we took it as today, what can I expect conservatively? And then our strategic approach, right? How are we going to reallocate property taxes? How are we going to strategically go after our insurance rates? Also combining loan to value, rate, amortization, the debt service cover, and then cash flow. We wrap up that memo with risk and exit strategy. What is your refinance path? A lot of my clients want to know, hey, based on forced value appreciation, based on future valuation of this property, could I take my capital back out in 2-5 years, right? Can I do a refinance cash out because that's non-taxable? Or, hey, Ryan, I buy and sell these every couple of years, and I'm using this more or less as to I want to go from 2 units to 4 units to 8 units to 16, right? That's what I'm personally doing. Everything I buy is investing into a move-up market for me. That's my personal strategy. And then I'm taking, so it's refinance path, a sale path, or even those worst case scenarios. So last thing I'll leave you with before heading into the Q&A is I want you to make sure in that same memo that you get from me who's involved in this transaction. Is this going to be a hard line that we're crossing with someone? Because I don't believe that they're going to provide us true, reliable data. Crossing maybe I don't know if that other agent has a strong ethical practice in business. And how do I protect those relationships? So I'm excited for this next portion. This next portion, I've invited John and Brock to be on today. And why they're here is because they've already helped advise a lot of my clients on mortgage broker products. Brokers are different than walking into a credit union. They're different than walking into a bank because they can shop other portfolios, other investors doing loans, and then they can structure that on the back end to do creative financing. So John, Brock, if you guys want to go ahead and unmute yourself here. Quick intro for you. I know a lot of people are talking about a lot of things today, but before that, just, what more about you guys?
Yeah, thank you, Ryan. Appreciate the invite and having Brock and I as part of this. Myself personally, I've been in the mortgage space for 30 years. So reference to gray hair, that kind of substantiates that. In addition to that, I've done some things, real estate development, buying and selling investment properties. I hold a few right now. As a matter of fact, on this one that I purchased, I did use the DSCR structure myself. So it's kind of a testament to the strength of that product. So yeah, primarily we are with Elevation Mortgage here. Brock, I'll let you introduce yourself and your experience and your background.
Sure. My name is Brock Blanchard. I've been working with John here at Elevation Mortgage for just about a year, but my background, been in the financial space for about 20 years. Cut my teeth at a local credit union, doing a variety of different roles from retail banking to mortgage origination, and eventually found the opportunity to break off into the broker world. And really the big thing that drew me to it is the flexibility that Ryan mentioned. There's just adding more tools to the toolbox and, not limited by just one set of programs. So it just gives me more opportunities and more options to help people find the right fit for their transaction.
Okay. Well, I love that, guys. Well, we're going to jump right in, and just to segue that same topic for people that might not know, what does a mortgage broker do, and how is that different than like walking into a credit union or a bank?
Yeah, that's a great question. The reality behind that is there's plenty of wholesale excuse me investors out there, right? Hundreds of wholesale investors. Um, as a broker, we have the ability to investigate their products, see if it's a good fit for us, see if they offer some products that we don't currently offer, and then we can sign up with that investor and utilize their tools and their products. So me, what I do is I look at what we have as a mix of products, how that fits in with our traditional buyer, first-time home buyer, somebody looking to buy an occupied property, government loans, all that stuff. But the beautiful thing about that is it's given us access to a lot of investor products, such as, like we've talked about, the DSCR, the bank statement programs, commercial stuff that is typically not available on the residential side. When I say commercial, we're going like 5 to 8 units and even about beyond that into like a true commercial product. So we have the ability to align ourselves with those wholesale investors that offer us just a great product mix that you might have to go to a couple different departments at a bank or a credit union. So, specifically on the residential side, I think it would be very difficult to walk into a bank or credit union and say, hey, do you offer some flexible options as far as income and assets on buying investment properties? Well, they might have to, hand you a card and say, go talk to so-and-so in a different department. So that's really the main difference. And a lot of people think, well, you're shopping, you can get better rates. Well, that's obviously part of it as well. But primarily for me, acting as the broker capacity, it's just providing a great product mix that we can really work with a lot of different buyers and different borrowers that you may or may not get at different institutions. So
Yeah.
that's really the main difference.
And what I've experienced with you guys too is it's that creative approach. You're taking the same approach to me as like, okay, let's learn about your portfolio. What's going to make sense here? What does that capital stack look like? And it builds in that flexibility as well. So I was talking earlier about debt service cover ratio and things like that. So, and I think this is extremely important for investors because this is most of the time when they realize they can switch from the residential side of business to the commercial business side of business, and not lose money, not lose structure. So can you speak to that type of loan product and how it's used?
Sure. Yeah, as you explained earlier, you simply just take your leases or your cash flow and divide that, by the PITIA. Typically, now they're not really factoring in maintenance. That's something an investor has to, evictions and the costs of that kind of thing. Repairs on the property, that's something that does not go into that factor. So that's something an investor is going to want to kind of tuck away on the side and say, I got to, account for that type of stuff. So yeah, what we're really finding on this, and in let's just take an apples to apples deal, same property, let's just use a single family, and let's just say pretty strong credit, 740. And we're looking at a down payment that is going to be the same as conventional, and the interest rates are trending a little better than a regular conventional loan. So nothing wrong with conventional loans. Those are great loans. The DSCR option does come with ease, right? So let's just say somebody has multiple properties or multiple businesses. On a conventional loan, we would have to say, okay, we want to see, 2 years tax returns for all those businesses, LLCs, and that in itself can be a full-time job gathering those documents.
For
You're not
sure.
thinking about the DSCR, and you're not paying a premium for that in most cases. It does depend on credit score and the ratio itself, but is the property itself is the cash flow. So there is no need to give us W-2s, tax returns, and that type of thing, which in itself creates just an ease of transaction for
Yeah.
someone. there is some flexibility there with the DSCR product as well. Yes, a nice coverage ratio would be at least one, anything above one, like Ryan, a good target is 1.25, like you said before. Now, a lot of people say, well, this isn't leased right now, so how do I even document any cash flow? So what they do is on the appraisal, the appraiser does a fair market rent for that property, comparing that to similar properties, and says, okay, the rent is probably going to be 2,000 on this property. They will go ahead and use that 2,000 as the cash flow. Now, if there's no true cash flow coming in, an investor is going to want to get that leased pretty quickly, obviously, right? So so you can go below the one on that DSCR ratio if need be.
Yeah.
Does that answer that question?
Yeah, what I have found with the debt service too is it removes what I'm doing in my personal life and allows me to perform strictly on, hey, I know this is a good property to purchase, right? So regardless of credit score, regardless of everything else in my personal life or the business, whatever it is, hey, I have the means of the down payment and to meet the loan of this. Let's look at this asset as its own business. And that's what I've seen the debt service do is like it treats that location, that business, that real estate as its own entity that has to perform, right?
Correct. Yes. And that is a feature that can be done. You can close in an LLC, and that does one of your other questions. I'll roll that into that at that time.
Yeah, sure. So I guess as we wrap just that question, where are you seeing most investors, over leveraging themselves without realizing it?
Yeah. And this is something that it's hard to predict or time, but what we see is somebody doing something below that 1%, and hoping that they'll just be able to continue to trend those rents up, which some cases they are able to do that. You get into the multiple units where you got multiple cash flows coming in, 2 to 4 units, obviously is a little bit, we found that to be a little more favorable than somebody trying to ride it alone on a single family. If that tenant moves out, now you have no cash flow. So finding the right property on a single family can certainly make sense. Where we see a lot of people maybe diminish their portfolio a little bit is those vacancies,
Perfect.
having more single families than multifamilies, not really being astute in the eviction process. One gentleman that we work with does a lot of Section 8 and is very good with navigating the court systems, and it's pretty much it need be a 30-day time frame to where he's able to refill that unit. So he's very good at it. What I find with him, I've been trying to talk to him a little more is maybe he's got 45, 50 doors now, and he still manages them all himself. And so if a pipe breaks, and he's very handy and he does a lot of the repairs himself or upfront remodels himself or has a small crew, but when he loses tenants, in bulk, then he really, excuse me, his stress levels, obviously tick up.
Yeah.
So I'd say that's the big thing we're seeing is tight DSCR ratios, not preparing for repairs, maintenances, and the vacancies.
Yeah. So heading in with the wrong structure, the wrong expectations of the property, a tenant moves out, I'm over leveraged and I'm gouging on my cash, personal cash.
Yeah.
So we want to make sure we don't do that to our buyers and make sure that they're prepared. So that's everything into that memo I was talking about earlier for proper structure. So Zach, I see your question here around the 75% financing, loan to value, market rate rents, and things like that. I think that will be answered here in a second. So, a lot of investors don't have enough cash in their pocket to come up with the down payment, but they want to pull in other people like co-signers, guarantors, or capital partners. How do you incorporate someone that wants the loan in their name, but also wants to receive funds from someone else?
Sure. On the DSCR product, you can do a co-signer. So they are responsible for, the note obligation, do not have a title interest in the property. Another thing we see really the most conducive structure is, if they want to form an LLC very quickly, right?
Mhm.
So it's not something that has to be in existence for, a couple of years, like a lot of times on conventional loans. Well, you got to have certainly the time and self-employment, the business existence. So they can do an LLC pretty quickly, pull in a group of people, pool those resources, and also have that protection, the liability protection of the LLC. So,
Cool. And then those funds, the money that comes in, you can use essentially the operating account from that and the operating agreement to say, yep, funds can come from multiple sources then, right?
yeah.
Okay, cool. Um, I've been asked this a lot over the last years. Can I do a non-recourse loan? Do you do non-recourse lending? And what is that, John?
Yeah, so Michigan is actually a recourse state. So essentially, what that means is if a lender has to go and foreclose on the property and there is a deficiency balance, they can technically come after you personally for that. The one thing, to be aware of, to be fully transparent, on the LLC closings, even in the DSCR, you still have a personal, I wouldn't call it a guarantee, but it's similar to a guarantee. You're still signing the note on behalf of the LLC person.
Yep.
So now in reality, Ryan, you can probably speak to this too. Even during the foreclosure days, how many lenders actually went and pursued that deficiency judgment? Probably a very small percentage, although, we did start to see it on credit reports, a year or two later, somebody still owed, XYZ bank from a foreclosure that they actually went after them personally. So, the state laws are going to usually trump that. Michigan is a state, even on regular conventional programs and so forth, where they technically could come after you for the deficiency balance. So one thing, the one nice thing about the investment property stuff is we do have one that you can do 15% down single family. For the most part, they're going to be 20 to 25% down. So you do have some equity in the game to buy that foreclosure time, unless the market really tumbles. But so one of my investors that I work with quite frequently, I've done a lot of refinances of his existing investment properties to pull cash out to put down on another one. And
Hmm.
I've said to him, not only for the rates, but for your protection. Now that you have a pretty good portfolio for your protection, I really don't want to go above 70% loan to value on your refinances, even though we could go higher. I'd like to keep you in a better position so you're not, you have really good equity position on your portfolio. So,
A follow-up to that question too, as I'm helping people build their portfolios and growth, they ask me, when do I need to stop coming up with a down payment? When are my assets just sufficient where they can put another loan on another property for me? So I think you might understand the question here is like, okay, at what point is the income from my real estate portfolio plus appreciation growing that I can continuously just always take the equity out of these properties to buy others? What does that look like for you, like, where it's not so much me as an individual now, but it's the book of business I've created come into play?
sure. That was one of the questions you had out there, the portfolio or the global DSCR. So that is another product where an investor will build up enough rooftops and doors and want to roll those into one. The old term was used to be kind of a blanket loan. So they have all those properties pulled in together, cash flow, values, and then in that scenario, what we can see is that they can fit another one in there without a down payment, right? They have a lot of equity in there. They'll let them put that one in there at essentially 100% financing. So they're looking at the total value of the portfolio or the business assets rather than one at a time.
Yeah. Okay. Well, I know we've generally stated this, but just in your experience, um, does personal income matter or does it not? And when does, and I'm really honing in on this because I get it so often, when does the business itself become the true borrower?
Um, on the commercial side, that's a little more conducive, other than the 1 to 4, in our case, 1 to 8 units. You can do and set up everything as the LLC. That's the most common thing. The LLC becomes, really the borrower. But again, just to be fully transparent, you are going to sign the note on behalf of the LLC personally.
Yeah.
So for all intents and purposes, it's LLC owning a bunch of different properties. But the lenders are smart enough to know that it's a little more difficult to go and pierce that veil, right, of the LLC. So they do have an attachment to that membership interest solely. But, for all, like I said, all intents and purposes, the somebody's able to keep moving forward, buying through this LLC or form another LLC based on the address of the property. But I just want to be fully transparent. It's not as if they don't have to sign and put themselves out there personally, just like a regular mortgage.
I think, and one of the reasons I value our relationship is I say something very similar from the real estate side, and I also say the same thing. It matters what the state laws are, right? Irregardless of what the lending practices are, it's the state law. It's case law that's going to dictate what happens, right? So especially in real estate, the state of Michigan in real estate is a buyer beware state. I don't care what the seller's disclosure says. I don't care what the inspection was, or all of these things, all of the due diligence we had to do up until the day of sale, you're going to sign at a title company, and it's well likely going to sign at a title company, and you're going to sign a document in there for a bill of sale, and it's going to say exactly that. You're taking this over. All contingencies have been met. Buyer beware, right? This like. Unless you can prove someone's explicitly hidden something from you, you're taking the property as is. And then the same thing for the recourse, non-recourse, the state law applies there too. So, well, as we wrap this up for the question section here, if you could leave our group, this room, with one piece of advice to avoid financial pain in their first or their next multifamily deal or whatever may be coming up, what would that be from your perspective?
Well, and I think with your input and all the evaluations that you do, it covers a lot of that, right?
Yep.
And I think, interest rate is important. Certainly structure and flexibility is equally as important, or, right up there. I think it's just a matter of kind of looking at the history of the property, the area. Are you going to be able to count on that tenant? Finding a good tenant, right? Somebody that you can rely on to pay you every month. And with the down payment that you are required to put in on that first one, and looking at that DSCR ratio, making sure you have a little cushion reserves. You had one question in there earlier. It's pretty standard with the DSCR product that you have to have 3 to 6 months reserves on the subject property. You may have multiple other properties. They don't factor those in. You don't need 3 to 6 months reserves for each property. So you want to make sure you have that 6 to 12 month reserve cushion for the unforeseen. But with your analysis and looking at the market rents and the appraisal that's done behind that, you do get a lot of diligence that happens behind the scenes. And, like I said, just be prepared for, you get a good deal, you're comfortable with the numbers up front. But as you said, taxes can change, a pipe could break, that type of thing. So just have enough fortitude and realize that those numbers can change throughout the next 12 months. And as long as you're comfortable with that and prepared for that, you've done all the heavy lifting up front. You got to trust in that.
Okay. Thanks, guys. So appreciate your time. So we got about 15 minutes left here. I don't think I'm going to take up all of that time. I really wanted to leave people with what am I seeing in the market? What are the predictions coming? What is this side of the state seeing? So my predictions, it's going to be pretty straightforward. It's more of the same this year. So the current administration, if you want to look at it from politics, and I'm not a politician, but we have to operate with whoever's in charge and whoever is going to be making the rules. Current administration really wants lower interest rates. So what I've been seeing with the rate market, with the expectation, Jerome Powell is out this summer. There's going to be a replacement in the Fed. Trump really wants lower rates. So it's anticipated that the mortgage market is already anticipating rate drops. I personally, and John, you're going to have your own opinion on this, but my personal opinion is we're going to see mid fives to low fives, and that's going to be a trend by the end of the year. Maybe we approach a 4% rate. However, if that person entering into office has any additional say of reducing that Fed rate any further that the mortgage rate had not already built into pricing and anticipation, well, maybe we see a little bit more of a frenzy on that rate and it drops. As we head into a market rate that's decreasing, what are we experiencing from the buyers and sellers in our market? We had nearly 13% more sellers in 2025 enter the market, and we had 12% more buyers enter the market. So there was only a despairing number there of 1% more sellers than buyers. That's extremely healthy. That's very stable. And then in most of our market areas, we were seeing 3 to 7% home appreciation year over year. Again, healthy. But this side of the state, West Michigan versus the Detroit metro side of the state, they are approaching 3 to 4, some areas more than 3 to 4 months of inventory. We are still underneath 2 months of inventory, meaning if all buyers and sellers, had a pause and no more sellers entered the market within 2 months, we would have no more houses for sale, right? We are anticipating if the rate drops heavily more than what the rate market's already anticipating, we're going to have a flocking of sellers entering the market. I would anticipate for 2026 and 2027, we may have somewhere between 15 and 20% more sellers entering the market because they're like, I don't know when I'm going to see the next interest rate drop, and I don't know if I want to wait for that. And they're going to jump on. And I don't think we're going to see the same amount of buyers come in. So I think if we're at 20% more sellers, I'm being vague in these numbers, but similar to what we saw last year, we're going to only see 15% more buyers. I think we're going to have a larger despairing amount of buyers than sellers entering. What do we know in our playbook for that is one, as a buyer's agent, I'm usually going to have stronger negotiation terms from the seller. Pricing for my sellers, I need to have stronger pricing, and I can't just put out there, well, the market rate rents are this, right? It's not going to be market performance. It's going to be current performance because you're taking on that risk as the buyer. So it's better advice for my sellers heading into the market as well. So is this a buying year? Is this a selling year? This is still a buying year for me. So I'm personally been negotiating for about 2 months to go under contract for about a 1 acre piece of land in Grand Rapids where I can ideally build a 40 to 48 unit apartment complex. It will likely charge somewhere between 13 and 15 million for me to do a full build out of this, including the land and everything. It's about a 3 year project. So I know I'm investing in a 3 year project because I think by 2027 and into 2028, the debt ceiling that we have in a nation, the compound interest rate on that debt ceiling, it has to do something for a correction. So by 2029, I want to own an appropriate amount of real estate and be ready for that. So I'm personally anticipating some corrections, but that's not stopping me from buying or doing something today. I think we're going to see that correction towards the beginning of 2028. It could be 2029. And honestly, that's the economists that I'm listening to. So, and I feel strongly enough about that to say this is still a buying season because of the other market trends and how strong West Michigan is. West Michigan is what I call a unicorn market. This is the Ottawa County and Kent County areas specifically, where you can, one, get rent appreciation and house appreciation. Most investors are only going to get one or the other, not both. We are that unicorn market because we can literally strategize around getting both of those. So everyone, thank you so much. I'm going to wrap up here and then give a shout out to Zach. He had to pop off, so I'll say something nice about him. So call to action for you guys. If this was anything of value to you, I want to be clear what you can do for a next step. This is not me pitching you the next deal. This is really me trying to give back to our community to help you grow in understanding of real estate. So I want to be in alignment with your goals. One, I want to be in alignment with you and your motivations. Because that right strategy only works if we have a good team here and the right people working together. So if this resonated with you, the next step for you is pretty simple. Let's schedule 15 to 30 minutes to have a one-on-one. In that conversation, we're going to talk about what you actually want out of real estate, what you want out of life, what you would expect for a risk tolerance, what you're comfortable with, build a business plan together. And then we're going to try and go out and find that and see if there's anything getting in the way of you obtaining that goal. From there, we'll see if how we align that search criteria and business criteria. And if there is anything preventing us, we'll map out the next wise decisions for you. After today's webinar, I'm also going to send you a post feedback link from my team. You'll probably see that same email come out from Tiffany. So thank you, Tiffany. Shout out to you for setting this all up today. My backbone here. What you can do from that link is book a time directly on my calendar. this is all recorded. You can rewatch any of this, send it to your family and friends, please, and you'll have access to our future trainings. So we're planning on 4 of these this year. Our next meetup is planned. You can mark your calendars if you want. Take notes here. Wednesday, April 29th, we're going to have a local meetup here. I'll probably ideally bring out food trucks and things like that and with our sponsors and say, hey, let's have an investor meetup here near our office here in Grand Rapids. So if this community feels like something you want to be a part of and you want to be a part of these conversations, again, thank you so much. We are not trying to just win a deal right now. We are trying to set you up for the next decade of your business. So, final shout out to Zach as he popped off. So, recognizing him, he's one of my key sponsors. He's also someone that I'm personally in business with. So, Zach and Bree, they own Real Property Management here, local in the Grand Rapids area. They are personally servicing my book of business as property managers. And I'll be honest, they are not your cheapest option in this area. And what that actually means to me and why that should matter to you is because you're going to get something for what you pay for, right? And we talk about that with you guys too, right, Brock and John? Like, there's charges to doing business with us, but it goes beyond just that charge. So in property management, the goal isn't just to have tenants place. The goal is to place the right tenant, right? John was saying, hey, if he could leave you with any advice, it'd be to make sure that you have good tenants, right? Because that's your income. And there's other businesses that you have to have cash flow from. We talk about that too, but we need to keep them happy. And Zach and his wife, Bree, do a fantastic job of that. They maintain strong professionalism and communication on both sides of owners and tenants. So they are consistently, for me, delivering in value beyond a discount rate because they do have high communication skills and they're actually, and I don't mean this in any way rude, they're intelligent. So and other people I've worked with in the industry on tenant management don't have the level of intelligence it takes to perform. So yes, you can get the right tenant placed. Yes, you can do that with discount brokers, but in my experience, that savings is going to show up in higher repair cost, missed details, and reactive management. So everyone makes their money somehow. I'd rather invest in quality upfront. So personally, I would always choose the better communication and those that can clearly show that over a few dollars saved. So Zach, Bree, sorry, I had to give you the shout out myself instead of you being able to say that as a sponsor of today. So thank you everyone for being a part of our community. I'll wrap it up there and we'll see you at the next meetup. Thanks, guys.